Welcome to vTalkInsight, Market Drivers Daily for March 18th, 2026. An escalating energy shock in the Gulf is colliding with a higher-for-longer interest rate narrative and a fresh upside surprise in inflation data. Those three forces together are now driving the key repricing risks across equities, rates, credit, and commodities. So let's start with the energy picture. The global energy story has shifted from a one-off shock to a potentially prolonged regime change in pricing. Persistent disruption around the Strait of Hormuz, where Iranian actions have effectively closed a route to most international tankers and removed an estimated 15 million barrels per day from global supply, is keeping Brent crude anchored above $100. Compared with just a few days ago, the focus has clearly moved from the size of the initial outage to how long these constraints last and what new price floor they imply. Under the surface, physical oil and refined product markets look far more stressed than headline futures suggest. Spot barrels delivered into hubs, such as Oman and Rotterdam, are reportedly trading $50 to $70 above Brent futures, with some regional spot prices spiking as high as $200 to $220 per barrel. Jet fuel is quoted above $200 globally. Diesel prices are surging, and inventories are being drawn down rapidly, including reports that China could exhaust roughly 1 billion barrels of stockpiles within weeks. Yet futures sit near $100 with only a $5 to $10 risk premium priced in, and there is still no meaningful evidence of demand destruction, which leaves substantial upside risk if disruptions persist. The macro fallout is uneven across regions and sectors. Europe is particularly exposed. Natural gas prices are projected to stay around 40% higher than previously expected through 2027. Inventories are low after a cold winter, and reduced Qatari LNG means Europe must outbid Asia for supply. That is already feeding into industry, with companies like Germany's BASF announcing 30% price hikes on some products and Middle Eastern aluminum smelters struggling to secure raw materials, raising the risk of production cuts. Food and fertilizer chains are also in the firing line, with energy-driven costs suggesting upside risk for agricultural commodities, while emerging markets face additional strain from higher food and fuel prices. Asset markets, however, are not trading as though this is a full-blown crisis just yet. Energy equities have outperformed, rising around 4% since late February as investors lean into a possible structural re-rating of the sector, and U.S. assets are still being treated as relative safe havens given America's role as a major energy producer. But broader equities remain resilient, and many participants appear to be hedging via options rather than materially shifting outright exposure, suggesting a degree of complacency about left-tail outcomes. Base case pricing still assumes that disruptions ease within months, yet scenarios where Hormuz remains constrained for several quarters point to oil at $125 or higher and a rising probability of global recession. Even if the conflict is resolved, long-dated crude for 2027 and 2028 has already moved from the low 60s into the high 60s and low 70s, embedding a $5 to $10 structural geopolitical premium. Key watch points now are the durability of Iraq's pipeline exports via Turkey, the security of Iranian infrastructure after recent strikes on major gas fields, and any signs of genuine demand destruction in transport fuels. How central banks respond to this evolving energy backdrop is the next critical link in the chain. The monetary policy narrative has pivoted decisively toward higher for longer as the energy shock collides with already sticky inflation. Market pricing has largely removed expectations for Federal Reserve rate cuts this year, and in some curves a full cut is now pushed out toward mid-2027. The Fed's own projections reinforce that direction of travel. The estimated neutral rate has been nudged up to about 3.1%, and the 2024 PCE inflation forecast has been raised from 2.4 to 2.7%, all while the policy rate is described as at the high end of neutral or mildly restrictive. Policymakers face a classic two-sided risk problem. On one side, labor market data are softening and credit conditions are tightening, with early cracks visible in private credit and broader concerns about funding costs if rates stay elevated. On the other, core inflation remains above target, and new energy-driven pressures raise the risk that inflation expectations drift higher, something central banks are keen to avoid after past policy mistakes. Within the Federal Reserve, divisions are pronounced. Some officials are concerned about labor weakness, while others focus on persistent inflation overshoots and have even floated the possibility of renewed hikes. Yet the prevailing stance remains a cautious pause, with central banks including the Fed, ECB, and Bank of England expected to emphasize uncertainty, the negative growth implications of the energy shock, and a strong commitment to the 2% inflation target rather than delivering outright hawkish surprises. Rate markets have responded with a meaningful repricing of the path ahead. Fed funds futures now reflect a much flatter easing trajectory. Term premia have risen as bond investors demand compensation for inflation uncertainty, and 10-year yields have retraced a recent 30 basis point rally. U.S. fixed income has outperformed in recent months on higher yields, but there is growing concern that longer duration could underperform if central banks lean more hawkish in response to persistent inflation data. At the front end, sustained higher policy rates are pulling institutional cash into money market and ultra-short funds, where yields above 4% remain attractive even through the typical first quarter tax-related outflow season. Those liquidity buffers could turn into dry powder for risk assets if geopolitical tensions ease, but for now they underscore a preference for safety amid policy and energy uncertainty. There's also a lively debate about what would constitute a policy mistake from here. Some commentators argue that raising rates in response to a supply-driven oil shock would echo missteps seen in 2008 and 2011, since monetary tightening cannot repair damaged pipelines or reopen shipping lanes. They note that studies of oil at $85 for a couple of months point to only a modest direct impact on U.S. inflation and negligible growth effects, especially given increased energy efficiency and America's status as a major producer. Others counter that repeated shocks from tariffs, the pandemic, and now energy risk unanchoring inflation expectations unless central banks lean hawkish, even at the cost of weaker growth. The most supported near-term scenario in current commentary is that central banks, led by the Fed, stay on hold and highly data-dependent, waiting to see whether energy-driven inflation seeps into core and wages before contemplating either cuts or hikes. The fulcrum of that decision is the inflation data itself, which have turned uncomfortably hot just as the oil shock intensifies. The latest inflation readings show clear signs of reacceleration, complicating any case for near-term policy easing. February's producer price index rose 0.7% month-on-month and 3.4% year-on-year, roughly double prior expectations, with the largest monthly gain in final demand goods since mid-2023. Core PCE inflation is running around 3%, and some estimates suggest it is annualizing closer to 4.5% once recent data are incorporated. Reflecting this, the Fed has lifted its 2024 PCE and core PCE forecast to 2.7%, and market pricing now implies inflation remaining above the 2% target well into 2027. Beneath the headline numbers, the composition of inflation points to broad-based pressure. On the goods side, food prices are a major contributor, with fresh and dried vegetables reportedly surging over 40% in a single month, and energy shocks feeding through diesel and transportation costs into wider supply chains. European chemicals and industrials are raising prices sharply as feedstock costs spike, while aluminum and petrochemical producers face potential production cuts due to input shortages. Services inflation remains sticky as well, especially in travel accommodation and financial services, and U.S. healthcare costs continue to outpace wage growth. At the same time, strong spending linked to fiscal support and AI-related investment in data centers is adding to demand, suggesting that both supply and demand forces are now working against rapid disinflation. Asset markets are struggling to digest this mix of higher inflation and slower growth risk. Hotter than expected wholesale inflation and the latest jump in oil prices have weighed on equities, with the S&P 500 Nasdaq trading lower and futures turning negative after initial gains. 10-year Treasury yields have edged back above 4.2%, yield curves have flattened, and traditional hedges like gold have underperformed even as the dollar's safe haven appeal strengthens. Crypto assets, by contrast, have held up relatively well, with Bitcoin trading near 70,000 and Ether posting solid gains, highlighting a degree of market divergence. Yet despite the inflation surprise and energy shock, analysts have not materially revised down corporate profit forecasts, which helps explain why broader equities are not yet pricing a full recession, even as talk of stagflation becomes more prominent. The inflation outlook from here hinges on how persistent the current shocks prove to be. Some analysis suggests that if oil prices merely stay in the 80s for a short period, the direct impact on U.S. inflation and growth is modest, and the pass-through to core is limited unless the shock endures for several months. The U.S. economy is also less energy-intensive than in past cycles, which should cushion the blow compared with Europe and many emerging markets. However, repeated upside surprises in both energy and food risk rekindling the post-pandemic experience, where supposedly transitory inflation lasted far longer than expected. Fed officials therefore continue to stress their commitment to 2%, even as they acknowledge high uncertainty around oil prices and geopolitical developments. For markets, the key markers are upcoming producer price and core PCE releases, gasoline and diesel trends at the pump, and any signs of second-round effects in wages and corporate pricing strategies. Those indicators will determine whether today's energy shock remains a temporary flare-up in inflation or hardens into a longer-lasting regime that would force a much more significant repricing across assets. To wrap up, energy markets are now embedding a structural geopolitical premium, with physical prices flashing stress that is not yet fully reflected in futures or broader risk assets. Central banks are responding to that backdrop and to hotter inflation data by leaning into a higher-for-longer stance, favoring a cautious pause while they monitor whether energy costs bleed into core prices and wages. For portfolios, the key moving parts are the duration of Strait of Hormuz disruptions, the trajectory of core inflation and inflation expectations, and how far rate cut timelines are pushed out as a result. Cross-asset signals remain mixed, so watching the interaction between oil, break-evens, credit conditions, and earnings guidance will be crucial over the next few weeks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.